So this video is a follow-up to my analysis of Pfizer, which was just finished, a kind of a sequel, where I finished on the note that I want to kind of discuss and get deeper into in this video of the Pfizer that is probably trading at a fair value and that the market is probably giving it a fair valuation and a fair price currently, given all the information that is currently known. And of course, it will change as new information will be received about Pfizer's drugs, if they succeed, if they get approval, if suddenly there are better prospects for their revenues, for the profits. And so the market's calculating obviously all of that into the price already. And even if at first when you look at Pfizer, it seems like it's trading at a lower valuation, after you look at all the details, you realize that it's probably currently, again, probably fair. So obviously this is all a discussion about the market efficiency and how efficient is the market, and can we as retail investors try, even should we try to beat the market? And I think that we might produce an outstanding special returns by having kind of an advantage over the market. So obviously this is a discussion about the market efficiency, and should and can we as retail investors, should we try even to find stocks when they are undervalued, and is there such a concept even, a stock that is undervalued when the market is efficient and is probably calculating all the information already into the stock price? So obviously me as a retail investor, I don't believe it always to be the case, and I want to kind of separate and just to give a discussion for myself also in this video about how the market is efficient, when the market is efficient, and gives a specific examples. And this is a very broad subject. Books can be written about it, 3, 4, 5, 7 hour lectures can be made about it. So I just want to give a small nugget about this topic, and I will probably get into it again in the future videos, and maybe to have a different angle, a different discussion about more thoughts on the topic of market efficiency. But what I want to just say in this video, I hope I'm gonna make it quick. Do not count on it because it never works. That yes, probably with Pfizer the market is efficient, and Pfizer is one of the, and that's not going to be my point, but Pfizer is one of the biggest known stocks in the market, one of the most followed ones by analysts, by institutional investors, by retail investors. It has so many information, news, and the estimates around it. What are the odds for us retail investors to have some kind of special insight about a stock like Pfizer? Usually none. Usually there will not be a special insight, because usually if it's just the business information that is surrounding the stock is already priced in. So what am I even doing? Me, Alex, I'm a retail investor. I'm currently focusing on dividend stocks. I'm focusing and I'm invested in one of the other very big, very well-known, very large market cap, mega cap stocks. So is it always true? Can I even try to beat the market? Can I even really catch stocks when they trading at a valuation which is unfair, which is too cheap, which is undervalued? Which is undervalued despite the information that we have, and I think yes. So Howard Marks talks about it in his book, which is maybe the best book that I've read about value investing, and the most important thing. And he has a chapter about, I don't remember, I read it a long time ago, so take everything with a grain of salt, but it kind of stuck to me, and maybe it's not a full chapter. I remember that he addressed the topic of market efficiency, and he has like this blended approach to investing overall, when he kind of mixes efficient market theory with schools of thought like Warren Buffett and Charlie Munger, which absolutely deny efficient market theory, and he kind kind of, for me, it was a bit confusing even to read about it when he blends the two of them together. And he does it with market efficiency too, when he says that most of the time the market is efficient, but there will be anomalies sometimes. And we're trying to catch those anomalies. But not only, because you can still invest in a stock knowing that its price is efficient. It's not gonna be value investing, which is completely okay. It might be, for example, dividend growth investors, which I'm sure I have a few of those already here, when you invest in a stock which maybe today doesn't have a significant upside to its current fair price, but it has an inherent growth in its business and in its dividend, and you hold in it for many years and enjoying this growth in the dividend and also the stock appreciation due to the growth of the business. And it's completely okay. So you can invest in markets even when they are efficient, because markets go up in the long term, right? But you can also try to find the inefficiencies in the market. And when I today looked at Pfizer, I was wondering whether there is an inefficiency in the market or not. And my eventual conclusion was that there was not. It seemed for me, this is of course my opinion, and whether you agree with me or not, just the concept of my conclusion was that given all the information I gathered about Pfizer, it seems like the current, like more depressed valuation that the stock is trading at seems to be fair and justified. So it seems to me that the market is efficient in this case. And I think most of the times, especially when you research a stock such as Pfizer, most of the time there will be a good reason for whatever valuation there is for the stock, whether it's low, whether it's high. So again, what am I doing here as a retail investor? Where are those opportunities? And currently, I'm sure there are more, but I want to mention two types of opportunities for me that I'm currently looking at, and maybe I should focus on just to lay my thoughts here. So the first opportunity that I can find, for example, in those dividend stocks that I track, is when the market overreacts. And yes, there might be a good reason for the stock price to fall. In my case, because I do not short stock, so I look for that down price. There might be good reason for the stock to fall, but maybe the market has overreacted and the price fell too much. So just to give an example, let me switch just to sharing my screen. So this is Global Life, a company which I don't know a lot about. I've never researched it deeply, but it's in life and health insurance. And we see this beautiful track record of growth for the company. We see it has a rating from S&P. We see a nice low dividend, obviously a dividend growth stock. And recently, this is the example I want to give, there has been, I think, a short report about the stock, which caused a complete plummet in the stock price. And I think for me, I hadn't had the time then, and I kind of avoided insurance stocks also. But for when it happened, I just looked at it, and it was so obvious the market is overreacting. And could the stock get even lower and continue to trade down after this short report and just to continue to going down here? Of course it could, and that's a risk you always take as an investor. But I think most probably the market was absolutely overreacting to those news, and those are definitely maybe the most prominent example when the market is inefficient. So that's just one example. But for me, what I currently focusing on, and all the dividend, almost all the dividend stocks in my portfolio, what I am playing on, and that's kind of already not investing, but kind of swing trading, and I've said it a few times already on this channel, is more just taking advantage of the natural swings in the price of the stock, even when there are no significant news about it. So for me, I said it already in one of my previous videos, where I probably will focus on stocks which are not significantly undervalued, because there is usually a good reason for it, and it might be already that the market is really pricing in seriously bad news about the company and its prospects. But just if not, the small undervaluation, the small swings in the price of the stock. So I'm not gonna give JJ again as an example, which is a great example, by the way, but I'm gonna just to diversify a little bit with my examples, give an example of Roche, which I bought around here, I think near the bottom. I'm not sure. Yeah, I don't remember already, but somewhere here. And I sold it when it reached that orange line at $40. And now after a few weeks already, it's still trading at $40. We've seen it gone a little bit up and then back. So those are just swings that are usually insignificant in the stock price. Maybe that's not the best example because it's pretty volatile, but there were no so significantly bad news for the company like there are with Pfizer and with a few other stocks that I do hold. But it's just taking advantage of the swings in the price stock. Maybe just to give another example, Bank of Nova Scotia, which I hold, and I also recently reduced my position after it traded up a little bit. So just those natural swings in the price of the business. Sometimes there is some kind of reason for it, and it's not that those swings are absolutely just happen for no reason. Sometimes there is a reason. Usually, it's not going to be the most significant because and therefore the undervaluation is also not significant. Sometimes those are just swings with no significant use. Okay, like J&J, I will give the J&J, just it's the one I have right now. When you have those just usual swings in the business, also I bought it really when it touched the orange line, or even a little below, and I sold it when it almost reached I reduced my position when it almost reached the blue line, and I'm currently holding it. If it goes again to those valuations, I will sell it completely and wait for a new entry price, and this is my current strategy. So this is kind of my favorite thing to do right now, and if it takes a while, I'm completely fine with holding it and collected the dividend in the meanwhile. So that's the second type of opportunity that I can see in the market, although the market is usually efficient. And the third type of opportunity is when my time horizon is long and I can wait. And you know that yes, there are bad news currently surrounding the company, and its performance might be low, bad for the next year, 2 years, 3 years, but I am willing to hold it through until the other end, and then I will see, and then I believe that when it trends up again and when it recovers, I will see good returns from all this time. This is a bit of risky, in my opinion, not my favorite one, because you don't know how long it will take, and I've got burned by it. That's how I thought about my growth stocks that I'm holding, and it's taking way longer, and it's really eroding my returns. But just to give an example, currently, for example, GPC, which I did a video about, and then it price fell, and I still need to decide what I'm gonna do with it. I'm gonna do a separate video about it. But yeah, GPC, its price fallen because its estimates are falling, and just a few weeks ago, with this orange line, the earnings were supposed to be flat, and now there are bad news. The earnings are falling, and so is the stock price, and of course it's justified. And it's not like the current price is inefficient. It's not like the market is overreacting. Maybe it is a little bit overreacting. I don't think so, by the way. But maybe for me or for you, whoever, I am willing to buy it in the current price and hold it out because there is some cyclicality. It's obviously related to the auto industry, and right now it's facing some macro issues, and maybe I think it's a good buying opportunity even without the dividend. The dividend is of course a nice add-on, a nice bonus, but even without the dividend, I believe that if I buy it in this price, even if this price is currently efficient, because the market is a little bit more short-sighted, its horizon is usually like 2-3 years, maybe 4 years, it depends, but maybe if I extend my horizon, or my investment horizon, then I do think it's a good opportunity, and I will see outsized return from it. I'm not saying that's exactly necessarily the case with GPC. I need to check, I need to research it a little bit deeper, and I will probably share my thoughts on a separate video. But just to give an example and to illustrate that, so those are like just off the top of my head, the three kind of opportunities that I think there might be like value opportunities in the market, when the market, yes, it's usually is efficient, but there are, first of all, inefficiencies when the market overreacts to the bottom, and when it gets exuberant and euphoric and is too optimistic too. Absolutely, and we can see it with many companies. So I don't know, is the market efficient in this case? Probably not, I don't know. So this is the first market inefficiency that might be. The second opportunity for me, again, are just the natural price swings. You know, the stock is not always trading at its fair value. It is kind of swinging up and down with no serious news also. So just to take advantage of that, maybe not the best example, but just to give that, you know, you don't get a lot of news, bad news about Berkshire Hathaway, and yeah, the price swings also. So a bit overvalued in my opinion. But and the third opportunity is when, again, you are willing to wait more. You're deciding to be more patient than the market, collect the dividend in the meanwhile, if you're a dividend investor, if this is a dividend stock, and wait for the bad news to pass. Of course, I didn't mention, but it was an important point to mention, that those bad news are temporary. When you think those news are temporary and you believe it's gonna be okay in just 2-3 years, again, usually due to cyclicality, but not necessarily. I kind of implied it, but I didn't say it too clearly. And you're willing to wait while the market has a shorter time horizon. That also might be a good opportunity, even though the market is usually efficient, and especially with such popular and very followed, very tracked companies like all the companies I mentioned in this video. So yeah, so just to give a few thoughts, I would love to hear. Please comment, let me know what you think. I would love to hear. So just again, sharing a few thoughts. Many more things could be said by me, and not only about market efficiency, just a few personal thoughts on this subject. So yeah, so that's it for now, and I'll see you in the next one. Bye bye.